lifetime income. Hey, that's what annuities are for, right? I mean, the definition of annuity is a consistent stream of payments. If you work at an employer and they give you a pension, it's a form of an annuity. Social Security, a form of an annuity. Annuities date back to the Roman Empire. They've been around long time. But when it comes to income annuities in today's marketplace, there's different types of annuities that you can own and different structures. The most common structure is the fixed index annuity with an income rider. Okay, there's also SPIAs, single premium immediate annuities, and also DIAs, deferred income annuities. They all have little different features, but at the end of the day, they're designed to give you lifetime income. So in today's video, I want to talk about the fixed index annuity with a lifetime income rider. The reason why the word rider is important is because rider in the world of insurance and financial services means extra. So you have a rider generally that you have to pay a fee for, and we're going to break that down a little bit too. But this rider gives you lifetime income, but it does not require the client to actually annuitize the contract. And the key part about that is they have a lot more control over the asset. They can change their mind in the future if they wanted to. If they passed away, there's more favorable death benefit options. Okay, there's a lot more flexibility with an index annuity with an income rider than there is with just a SPIA or a DIA. Now, with the rider fee itself, some have no fees, but generally pay a lot lower income. And the way I explain this to folks is like, look, if they're not going to charge you any type of fee whatsoever, and they're going to give you this massive lifetime income, it's too good to be true. They have to charge this fee. And it's not like they're pocketing that fee and going to Vegas with it. They use it for expenses and policy operation, and depending on the size of the case, maybe some of it goes to reinsurance. There are costs that these insurance companies have. They have to pay the agent a commission, they have to pay their staff, they have to keep the lights on, they got property tax, they got state fee, all these types of fees that they have to pay. They have to make some money, right? So for lifetime income riders, they generally have a fee. The big difference though is how is that fee calculated? It's very common. Agents say, oh, I help my client with this rider, or consumers will come to us and say, hey, I bought this income plan and it only has a 1% fee. But is it really 1%? It may say 1%, but is it really 1% that's taken out of the account value? The answer could be no. And here's what I mean by that. A lot of these annuities with the 1% fee or 1.1, 1.2, it always blows my mind. Like, why would they do 1.1? What is that mathematical equation where we need 10 extra basis points? Like, just make it 1. It's simple. But anyways, let's say for simplicity purposes, that it's just simply 1%, okay? The 1% fee, the first thing you want to ask is, what is that 1% fee based on? Is it based on my account value deducted from my account value, or is that 1% fee based on my income account value deducted from my account value? Before we get into those details, let me share a little bit more about what I mean by this income account value and account value. Generally speaking, with an income annuity that's a fixed index with an income rider, you have your account value with your money, then you also have an income account value. This is the account that is used to determine the amount of income that you're going to receive. This particular income account value has a particular interest rate being applied to it every year, either simple or compound. Some of them offer a bonus on that income account value. And then once the client goes to turn it on, whether single or joint, it's based on their age. And that age has a percentage factor with it. So they're going to take that percentage of the age and multiply it against the income account value. And that's how they determine how much income you get. There are companies that don't have any of that fun wonkiness. They're very straightforward. It's way easier to explain to people. But most of them that are competitive in today's marketplace and in the past marketplace and probably in the future marketplace are going to have an income account value. And they'll have marketing slogans like 20% income account value bonus, 50%. None of that matters, okay? What matters is how much is that client actually going to receive in their paycheck, in their guaranteed lifetime income check. What are they actually going to receive? Because you can have a 50% income value account bonus, and then the payout percentage factor is 2%, versus having no bonus and the payout percentage factor is, say, 7%. That's better. Ultimately, it's like, what is that client going to receive net into their pocket, okay? But when we go back to the fee here, that 1% fee on most of these policies is calculated on the income account value. So they move 100 grand over, and let's say it gets 7.2%, just for simplicity purposes here. Compound interest. In 10 years, that 100,000 is now worth 200,000. Is it the client's liquid money? The answer is no. It's used to determine how much income they're going to get, a part of their calculations, part of their formula. So that 200,000, that's usually where that fee is associated. So you get 1% fee on 200,000. Wait a second, that is more than 1% fee on 100,000. Yes, but that's how they do it. So you got to be careful and understand these contracts. And if you're a consumer listening to this, you want to just know what that fee is going towards. Now, at the end of the day, in my opinion, the fee is irrelevant. You're buying it for lifetime income. That fee does not affect your income. If anything, it's giving you the ability to receive more income than a plan without a fee. But you have to understand this. The consumer needs to know this. You as an agent and or advisor, you have to understand what this fee is actually doing to the accumulation value, which the accumulation value is equal to the death benefit value, or the surrender value is part of the formula for the surrender value. If they're out of surrender, then they have access to the account value, okay? But other companies will take that 1% fee and base it on the account value deducted from the account value. That's a little bit easier to explain. It's a much lower fee structure, but they may not have the highest income either. So in the other situation with some of the more competitive carriers that have a 1% fee on that income account value, and then they deduct it from the actual account value. So that $2,000 in this example, maybe the account value at that time is only $90,000. It didn't perform well, and that fee's been nibbling at it. $2,000 taken out of the account value on a $90,000 balance is much more than 1%. You just have to explain this to people, and you should not be out there trying to help people with annuities unless you have a full understanding of these basics. And it's not that complicated. All it takes is a phone call to the carrier to really review this. Or if you're a consumer watching this, you need to be sure that you ask your financial professional or insurance agent, hey, look, explain this fee to me. How is it calculated? What is it based on? What can I expect? That way there's no surprises. You don't want to help somebody with a plan and then 2 years later, it's not what they thought it was. They're all upset. There are all these fees. They want to cancel it. And then they have these huge surrender charges, market value adjustment, all that. You don't want to do that. You want to set the precedent correctly in the very beginning. The way that we help people is saying, look, if you want this policy, you can have the lifetime income. It's 100% contractually guaranteed by the insurance carrier, and they're going to make this payment to you for the rest of your entire life. Now, you are going to pay a fee for that, and this is how the fee operates. Again, if you're buying it for lifetime income, it doesn't matter about the fee. Your account value is going to get demolished. I tell people this all the time. Just kiss that account value goodbye. You don't care about that. The purpose of this money is to accomplish income, all right? So that account value is going to go down every year, not based on market volatility, but rather based on the fact that when you turn on income, you're going to be pulling income from that account value. And during that time frame, that fee is going to be nibbling and hitting and chiseling away at that account value. And if they have a good, solid, full understanding of that, every year when you do an annual review, it's a lot less awkward because you don't have to worry about explaining to them the fee again and the income account value. I have agents all the time that say, yeah, I just skipped over that and I showed them how much money their income account value is worth. Okay, so what? That's totally irrelevant. It's not even their money. They can't take it out and go to Vegas. It's just purely used for the calculation. I show people, look at your account value. It's dropped. Isn't that crazy? Yeah, you have lost money due to the fact that it did not earn any interest and you have a fee. But guess what? You didn't buy it for that. You bought it for the lifetime income. Remember that conversation? Yes, Roy, we do. Okay, great. You want to set the stage correctly. The more transparent you can be, the more thorough you can be, you're going to be able to have much better clientele and way more people that are happy with you than not doing it that way. Oftentimes, agents will just sell the income. They don't go over anything else. And then they have awkward reviews with their clients, or their clients talk to somebody and they discover about the fee, and then they come back to you and you have to do this whole rigmarole and re-explain everything. And it's just not worth it. Understand the basics, show the client how it actually works, and you won't have any problems. And remember, not everyone should own an annuity. Not everyone will buy an annuity. Only help those that want that type of security. Because if they try to combat you and say, I could do better in the markets, you know what I say? I say, absolutely. Statistically, historically, mathematically, yeah, the markets are going to yield better than what this account can actually provide to you. But what if it doesn't? This account is for those people that just want a guaranteed boring check. They want their own money paid back to them for the rest of their life, but they don't have to worry about sequence of returns risk. Maybe it helps fulfill RMDs, your required minimum distributions. Maybe it just gives them peace of mind. They don't want to deal with it. It's perfect for those people, but not everyone thinks that way. And I just very upfront with people. I said, yeah, I mean, if you were to put this into some sort of an index fund, I mean, I don't give advice on stocks, but you could do your own research. And yeah, it actually performs way better historically. But what if it doesn't? What if we go through a big crazy market downturn for a period of years, or we repeat what history has done before where it's up and then it's down and it's up and it's down? Do you want to ride that roller coaster with all of your assets? Or would you rather have a portion of your assets parked to the side? Okay, if you're an agent listening to this or an advisor and you want to learn more, we host our annual national conference every single year right here in Austin, Texas. We are growing and expanding our team. We have a separate process if you want to become a part of our team. And also, if you're a consumer listening to this and you want more information and you want to work directly with us as one of the nation's leading annuity providers, you can just fill out the form below, and we look forward to helping you and working with you. Thanks so much. Yours in success, Roy.